Welcome to the second class of our Angels School, or probably Angels Academy. Thank you all for joining. I have to remind all of us that our supporters, partners, and sponsors for today's event and the entire series of events are Latvian Ministry of Economics, our lovely partners SEB Banka, who are providing the lovely venue and facilities for us, and the United States Agency for International and Development with the genius help of American people. Today's topic is speaking about what is the term sheet, what's it all about, for what reason it was invented, and how to work with the term sheets and analyzing other aspects of prospecting deal in your favor, but not crushing the deal itself, to maintain the win-win balance, actually. That's it. I must say that today we were joined by our lovely friends and partners, Andra and Jokubas from Lithuanian Venture Capital Fund First Peak, and which is much more important, they are eager to invest. From time to time, my friend Dmitry, also a general partner at First Peak, calling me and asking me, do you have any more interesting startups to invest in? We are ready. That's our bank account, that's our checkbook. We are ready to start investing in your portfolio companies. So please, in networking break and afterwards, please take your time to reach out to Andra and Jokubas to present the startups from your own portfolio that are currently raising, and probably next deal will be yours. That's it. Some words about our today's session. If you have not joined our Telegram group yet, please do that, because we are placing there some notices, some learning stuff, and so on and so forth. Probably some more announcement during our upcoming sessions. That's it. I want to switch to the presentation, actually.
Hello, everyone. Very excited to be here today, and thank you, Kirill, for inviting us. Really appreciate it. We arranged the whole trip out of this training, meetings with investors, with founders, so a very, very good opportunity to come to Riga. And today I will be speaking about a relatively technical topic, right? Diving into term sheets and investment agreements to speak about the differences and similarities, some of the items that you should be aware of. But before I do that, I'm just curious, how many of you have been involved in negotiations when making investments into companies? Everyone, right? Okay, good. So just to understand the background and how much you already know, so that's good. We have the basics set, and then we can dive deeper. Before I begin, a very big face of me. No, but just want to briefly introduce myself. So I've been working in the tech space for 10 years now. Started my career in tech at Civita. Maybe some of you know this consulting firm, which is also operational in Latvia. And I have been working with innovation and startups over there. Since 2019, I've been a part of Startup Wise Guys. Maybe also this name is familiar. From the Lithuanian fund, we have invested in over 50 companies with that fund. And 2 years ago, we have launched First Pick, which is our own fund focusing on Baltic founders and the Baltic tech community. If you feel like connecting on LinkedIn, please feel free to do so. There's also my email at the bottom. So those portfolio companies, you can send their decks our way, and we will take a look. And just a little bit about us so that you understand where everything that I will be speaking about today is coming from. So First Pick is a high-speed venture capital fund and accelerator for Baltic companies. So we invest in technologically scalable startups coming from the Baltics, and usually we are the first Czech investor. So the first one that comes in on the cap table, sometimes alone, sometimes with angels, or sometimes after angels. So it depends on the situation. And the name came about because we wanted to be the first choice for founders, someone that's open, friendly, that can make a decision fast and allow founders to build. So we are their first pick, and we hope to be the startup's first pick too. This is our team. We are a team of 7, 4 partners that founded First Pick and joined by an incredible and talented team. Jokūbas is our investment analyst, overlooking all of the pipeline and making sure that we don't miss any good deals. So he's usually the first person that checks all the startups that we speak with. So make sure also to catch him during networking. And this is the portfolio from the current fund. You might notice that there is a Latvian company over there, Swazi. Maybe you have heard about them. And also half of a Latvian company, Finfra. So it was founded by a Latvian and Estonian, and they're building a fintech lending company in Indonesia. So they just announced a 2.5 million round that they raised today. So very, very good company. Excited to work with them. Right, and now we can dive deeper. I invite you to jump in, ask questions, share your own experience if you would like to at any point in time, so that we can have a nice discussion. And the 4 things that I want to cover: first, the term sheets, then the types of agreements that are usually in the startup space, some of the key clauses that you should be aware of, and some very short tips and tricks how to handle the legal negotiations when you want to invest into a company, or when a follow-on investor comes in and proposes their terms. So how to help your portfolio companies understand if the deal is good or not. Okay, so the first question, why do we need to know this, at least the basics? Why do you think it is important? Because you could just hire a lawyer, right? And the lawyer could do all the work for you. But why do you think it matters to know the key terms?
Probably some of the people who participated in our previous year school can recap the imitation game on making the proper term sheet that will not ruin the win-win balance, actually. And probably from my side, because a lot of people on both sides, let's say investors and startup founders, understand their own, let's say, benefit in a different way, actually, and not always in the benefit of the entire deal.
Yes. Yeah, this is a very thorough answer. Thank you, Kirill. But that is true. Every party in the agreement has their own, let's say, preference, right, for what the agreement would look like and how to make sure that they extract the maximum value from the deal. And sometimes you can have multiple investors even in the same round, and all of them want to make sure that they have the best position. So you, by understanding the key terms, you can make sure that you are protected as an angel, or that if it's a follow-on investment, that the founders are protected and you are protected in future rounds. So without good term sheets, without good investment agreements, the situation can be very tricky. You don't have good governance inside the company. Nobody understands the cap table. Nobody understands what happens in a bad case scenario. If a founder wants to leave, what do we do then? So you never really know, and it's tricky and messy and lengthy and can cost a lot of money in case you run into some problems. So it's always better to define certain rules of governance before you invest and before everything starts, because then if something goes wrong, you can always go back, look at the documents and say, okay, this is what we have agreed upon. So good, let's take a look at term sheet. So term sheet is usually the first document that a company gets when they receive an interest from an investor to, basically to invest into the company. And the term sheet is a non-binding statement, so this is important to understand. Even if the company receives a term sheet, it still is not like a 100% guarantee that the investment will follow through, because it's an intention to invest under specific terms, right? So if something goes wrong, like the company doesn't maybe pass due diligence, the investor might draw back the term sheet. And usually the term sheet outlines the main terms for aligning expectations between the investor and the founder. So what are some of the key clauses? Also, the term sheet typically has an expiration date. So let's say a fund issues it and says you have 2 weeks to decide, if you want to make this deal or not. And the term sheet is defined by the investment agreement. So we have, I would now say, 2 general types of investment agreements, but then we will dive a little bit deeper into them as well. So we have equity investment. I would say it's one of the most common and easiest to understand. Basically, when I invest money into a company and I receive shares in return. In that case, the term sheet has to have certain clauses, such as the investment amount, the valuation, and the equity stake that you would get. And the other type is the convertible loan or note or bond or debt, many alternative synonyms for basically the same instrument. And in this case, the term sheet has slightly more key definitions because it is a loan that you're making to the company. So you have to agree on the interest rate, you have to agree on the duration of this loan, when it will convert into shares, if there is a discount as well. So there are more clauses in that scenario. So let's first take a look at the equity investment agreement and what the term sheet has to include. So of course, we need to have the investment amount, right? Otherwise, what's the whole purpose of having this term sheet? We then have to define the valuation. What is the worth of the company? And typically, the term sheet includes either the pre-money or the post-money valuation. I think this is fairly simple to follow, right? To understand, everyone knows what we're talking about. Good. And of course, the equity stake. So we right away calculate what percentage I will receive for my investment, just to know exactly, what we will end up having. The convertible loan includes more information. So again, we start with investment, right? We then define the valuation cap. So this is the highest possible valuation at which the investors will convert their shares. And it might be that this valuation will be lower in case the investment that will be the follow-on investment is at different terms. So this is kind of the maximum at which we can convert. The discount, sometimes it is included, sometimes it isn't. It depends on the deal and on your negotiation power. The discount simply means that you will get a certain discount on the future share price of the company. So let's say if you get a 20% discount at the time when you need to convert your shares and the share price is €1, you will convert at 0.8 cents, right? So you will convert at 80 cents instead of €1 because you had this 20% discount. So this gives you a benefit because you are taking more risk as an early investor and therefore you are compensated through this discount mechanism.
May I ask
yes.
to clarify for the audience? Actually, it may mean that you will be converted at 20% lower than the new coming investor,
yes.
venture capitalists in most cases, right?
Yes, that is correct.
Mm-hmm.
So all the new investors in the next round of funding would convert at €1 per share. And because you have a discount, you would convert at 80 cents. What this means is that for the same amount of money, you are getting a larger number of shares. So you are benefited as opposed to future investors. But usually, you have either one or the other. It is very rare to have both the valuation cap and the discount. Typically, you have one or the other because otherwise the conditions are super preferential. So typically we try to, everyone tries to balance out the benefits for all the shareholders. But it can still happen, not saying that it's, it's unseen. Other elements that you have in the convertible loan agreement, first of all, it's the interest rate. So since you are issuing a loan for the startup, you can actually ask for interest on top of it. And in current market conditions, it's somewhere between 6 to 8%. It might be lower in future if the interest rates continue to drop. Like 2-3 years ago, it used to be 0. But now investors are saying, since the market situation is changing, we also want to have protection because of that. And then 2 final things. One is the maturity date. This means when my loan will convert into equity, the latest possible date and time. Usually it's 12 to 24 months, roughly. This is the standard in the market. And the last thing is the qualified financing round. What does it mean? So when I'm issuing this loan, there are a couple of scenarios when I will convert into a shareholder. One of them is when I reach this maturity date. So it means that the startup didn't raise any money within a 2-year time frame, and therefore I become a shareholder in the company. Scenario B is a qualified financing round. Qualified financing round is basically the next round of funding. So you pre-agree right away with the startup that if you raise 1 million euros, then I will convert into a shareholder. But if you raise less, 500,000, then I will not convert, and I will remain, this convertible loan agreement will remain. So it's a way to allow the company to raise smaller amounts of funding in case it is needed, like a bridge or a follow-on investment, on similar terms as your convertible loan, instead of, going into this like equity agreement right away. So this is pretty much it. Now, inside the term sheet, we also have some protective provisions for the investors, most of the cases. You may have come across some of these. One of them is liquidation preference. So, there is a lot of founders are scared about liquidation preference. They don't understand it. They don't understand what it means. Liquidation preference basically is a set of rules of how the money would be paid out in case there is a liquidity event. So, in case there is a merger, who will get how much money, in what sequence, and what order. So typically, the investors would have 1x liquidation preference. What this means is that the investor is the first one out of everyone to get their money back. And only then all the other shareholders will receive their money back. We will dive a little bit deeper into it later. Also, there's anti-dilution, meaning that you want to be protected against future dilution. So, if there is a down round, for example, if the company raises at a lower valuation, you want to make sure you will be protected as an investor. And there is board composition. So maybe for angels, it is not as relevant because angels typically do not take part in boards. But usually investors are asking for a board seat, especially in later rounds of funding, like seed, Series A. This is where investors want to have control of the management of the company. And last element that is important in the term sheet are the founders' commitments, meaning that you are putting in your money, so you expect the founders to really commit to building this. So one of them is vesting schedules, meaning that founders only get access to their shares over a period of time. So typically how it works is that there is a cliff of 1 year, and then the remaining of the shares vest over a 4-year period. So, the founders are really incentivized to work on the startup at least for 4 years so that they don't run away when things get hard and if they decide that they are, not interested in this anymore. So you want to be protected. And there is transfer restrictions. What it means is that founders cannot sell their shares for a certain period of time without the consent of other investors. So you also want to make sure that the founders really keep their share of pools and don't sell it to someone else so that they have control of the company. So these are some of the key terms. Whenever you see a term sheet, I would look through all of them because they are the most important. They typically are the cornerstone upon which the remaining of the investment agreement will be built. Now, this is an example of our term sheet. There is no one-size-fits-all term sheet in the markets. Every investor typically has their own document, so that's why it can be a bit tricky. You receive a document, you've never seen anything similar before. That's why you always have to look for those key terms, key definitions. We try to keep our our term sheet very, very simple. So we build it like a table. On the left-hand side, we have the main terms. And on the right-hand side, we have the kind of description of what these terms encompass. So here you see on the left-hand side, we have the investment round. And then there is an explanation of the investment amount, of the maturity date, of qualified financing, right? So this is for like convertible loan type of an investment. And then it continues. So actually the term sheet, I think it's something like maybe 5 to 7 pages. So it's not a very short document. And the main terms, all of them are outlined already. So if the founders decide to sign the term sheet, they know what they are committing to. Sometimes it happens that founders receive a term sheet and it's super short, like 1 page. And they think, nice, such a good deal. I like the investment terms. The valuation is good. I sign on it. And then they receive the whole investment agreement, and oh my God, the terms are terrible, and they don't want to sign on it because they think like this really is not aligned with our interest or with the interest of the company. So that's why it's good to have a bigger term sheet with the main terms already pre-agreed, so that there are no surprises in the future. We really already know what we are getting ourselves into.
May I interrupt you for a
Sure.
second? You said no surprises, no further surprises, but I met a lot of cases in my own practice when the founder, and one time it was even an investor, after carefully reading and signing the term sheet and further negotiations, when the time gets to the investment agreement, those people said, I didn't realize that it might work in this way. I disagree with this. How to deal with such kind of cases?
Yes. So majority of the negotiations, they do happen during the investment agreement stage. During term sheet stage, very rarely you would negotiate a lot. You negotiate on the deal terms, like the size of the investment, the valuation. But those, let's say the items that are there, typically they are very standard, like, I don't know, tag along, drag along. It's very typical, and rarely would you see that it's not market standard practice. But yes, majority of the negotiations happen during investment agreement, because you take a 5-page document and you turn it into a 30-page document. So there is much more detail, much more nuance. There are these smaller clauses that you need to be aware of. So it's actually normal, and this is where the majority of the negotiations takes place, and it's the lengthiest process in receiving the investment, actually. So we see that like founders get a term sheet, and it can take them another month or even 2 months until they actually sign off the investment agreement. So this is where you need to include lawyers, typically.
Yeah, but the term sheet is not really enforceable, right?
Exactly. Yes, it's non-binding, so you still can, back out from the investment.
In the Baltic legal environment, yeah?
It's everywhere.
In common law, would it be non-binding as well?
Yes, yes. Well, it is sort of like a gentleman's agreement, You come in, you get the term sheet, you think that everything works for you, you shake hands, and you kind of expect that you will find a compromise in the investment agreement anyways. So it's quite rare that people would be unable to agree on the main terms in the investment agreement, and they say, okay, we cancel this, this is it. So usually, someone makes a compromise here and someone makes a compromise there. And in the end of the day, the deal does happen. But in some scenarios, yes, it can also fall through, and founders can say, okay, like we don't want this investment anymore. But it's quite rare. Okay, so once you sign the term sheet, typically you move into legal due diligence. So the investor starts doing due diligence on the company. And then, of course, the negotiation and signing of the agreement. And like I said, the negotiation can take anywhere between a month and 2 months. And usually the parties, if it's a bigger investment round, like 1 million, 2 million, they involve lawyers in this process as well, just to make sure that their interests are best represented. Okay, so we can now take a look at the different agreements and maybe scenarios in where those agreements work best and when it is a good decision to choose the different agreements. So usually in the market, we see 3 types of agreements. One of them is the convertible loan agreement. So when you provide a short-term loan to the startup, and then you will convert into equity in the future. We have the SAFE agreement. This is the American-style investment agreement, very short, very simple. It originated from Silicon Valley. It's not so common in our market because it doesn't align with our legal foundation. So it is sort of like, you would give a loan to your friend. You take one page of a paper, you say, I give you this loan, I expect you to pay it back at this point in time. Yes, exactly. And like you sign, and this is it. And there's very, very little said about things like liquidation preference, anti-dilution, et cetera, et cetera. So it is a very small...
In Estonia it works.
Yes, we do see it from time to time that it happens. Maybe for like smaller angel investments, it can be a good choice because you like the founder, you trust them, you don't really want to hire lawyers and pay a lot for legal fees, so you just sign the safe agreement. But then a lot of the protection is really not there because it's not fully aligned with our legal base. So at least at first pick, we try to avoid safe agreements. But this is our preference. Instead of that, we try to lean into convertible note because then it's more aligned with our legal basis and it's a bit easier to also agree on the key terms, right, on those provisions that I mentioned before. And then, of course, we have the equity investment agreement. So this is the easiest to understand, but it's also the lengthiest of all the three documents. Because if you sign the equity investment agreement, you immediately become a shareholder of the company, and it means that the company has some bureaucratic things it needs to go through, like registering you as shareholders, et cetera, et cetera. So it can be a bit more lengthy than a convertible note agreement. So usually what we see is that convertible note is used in early stage companies and early stage deals, or in bridge financing if the company is raising a bridge investment. The safe investment agreement is also used for early stage companies for smaller tickets, and it is like an alternative to convertible note. It is also used by accelerators in the US especially, so it is quite a well-known format. And equity investment is usually for seed stage plus companies. You can see it in pre-stage as well, but usually it works best when the company is more mature.
You said
yes.
30 pages.
Yeah.
These are 30 pages? Convertible notes?
Safe is maybe like 5. 5, 7, depends. Convertible note, I've seen different versions of it. It can also range from 5 to 30. So it can be a short version, more similar to safe, or it can be a longer version that's more similar to equity. It depends on how many clauses you include in it. If you want to go through all the founder vesting, liquidation preference, all of this, then it can become bigger. But if you want to have a very, very short version, it can also be, just key terms and like this is it.
What about standardized set of documents? For example, the Estonian, I think, has on the web page, standardized set of documents.
These are really good. Yes, these are really good. I think we also tried doing something similar in Lithuania, but I'm not sure if we have succeeded. I don't know about Latvia, but Estonian documents I think they're good to start with. But if you were making the investment in a Latvian or Lithuanian company, I would still consult with lawyers to make sure that it's adjusted to the legal base in that country, because we are quite similar, but there are some small nuances. They're not very big. So, you could get away with that agreement. I think it would work in majority of the cases, but just to be fully protected, you might also want to adjust it a little bit. Yeah.
Why safe doesn't have maturity date?
It can. It can.
It should.
No, it doesn't. It doesn't.
It can have, yeah.
The original SAFE, then it says that if you use the template from SAFE, then it doesn't have the maturity date.
Yeah, the original doesn't have it. That is true.
Works like there is a condition of the round, but if round doesn't happen, it should have maturity date.
No, see.
Yes, that is the logic.
Within a certain period of time.
Yeah. So just to give you like a bit of maybe context. The SAFE was founded as a way to very quickly finance companies in Silicon Valley. There were a lot of angels, a lot of money in the market, and everyone wanted to make those small investments. But they also knew that majority of the startups, they will almost definitely raise the next round of funding. So they said, okay, let's simplify this. We are giving you, a very, very simple document because we trust you. We believe that you will raise the next round of funding. And when it happens, then we will decide, how we convert and everything else. Like this next round of funding will define the valuation and how much shares I will get, et cetera, et cetera. So that's why SAFE also doesn't have any cap. Like you don't decide on the valuation cap. You don't have the maturity date. So it's kind of like I said, issuing this debt to your friend, saying, okay, I signed this loan and this is it. Like maybe you'll repay me sometime in the future. Thank you. See you next year, something like that. So that's why it is not an ideal document if you really want to be protected as an investor. What is also important to note is that there have been variations to SAFE. So some people, they take the SAFE and they say, okay, but let's add the maturity date, or let's add, the valuation cap, just to have more protection as an investor. So you can also play with it.
50 million, then I guess there'll be some maturity.
Yeah, well, if it's 50 million, I don't think it will be safe,
No, I think it's safe.
Yeah.
Quite recently, and it realized, but not in kind of a brutal way.
Yes.
But that's a different story.
Well, it sounds like a very interesting story. We have to hear it.
Maturity, lots of conditions there.
Yeah.
What happens if they don't raise the round within like a year and a half? And now they merged with the competitor. And they said, the key investor said to SAFE holders, so we have to save the company. So we override your rights into the SAFE. Embed it into the SAFE, and they force signing different agreements.
Okay. Yeah, well, what a story.
Totally different way. So
yeah, but then of course.
Number of shares 3 times for SAFE holder.
Wow, that is crazy. But like this is why you need to have these clauses in the investment agreement, because otherwise you go into these situations where it's not always aligned with your best interest. Maybe what is one thing just final to mention about the SAFE? The idea in Silicon Valley was that if the company will not raise the next round of funding, they are not successful anyways. So even if I convert into a shareholder, it doesn't matter, probably the startup has died. So that was the kind of logic why the maturity date wasn't there, because they thought like, okay, for early stage funding, that's the harsh reality, the harsh war that founders are in. Okay, yeah, so here I just kind of also mentioned when you become a shareholder. So in a convertible note, it's during maturity date or the next round of funding. In terms of SAFE, it's always next round of funding. And in equity, it's immediately. So immediately you become a shareholder and the company needs to register you in the local registry. Some pros and cons why you should use certain investment agreements over others. So convertible note, it's fairly easy. The document is smaller. It's quicker to negotiate with the company. The downside is that you have this interest, especially right now in the current market conditions. So from the founder's perspective, this interest adds up and they need to convert it into additional shares. So, if you ask for interest, the founders will have to give more shares to you. And it's suitable, yes, for early stage funding or for bridge financing. With SAFE, it really is the easiest possible investment agreement that a company can ever sign. We touched upon that already. Usually, yes, there is no interest on it, so founders don't have to give additional shares or repay the interest. With investor risk, yes, there is no downside protection. There's very limited protection in general because not all the key terms are included. And there is lack of regulation. So it works well in the US legal system. It doesn't work so good, at least here in the European legal system. So it can there can be potential misunderstandings, like you mentioned, right? So it can be quite big legal fees. And it's usually suitable also for early stage companies, or maybe if they participate in some acceleration programs, then SAFE sometimes is used. With equity, it's the most structured, the easiest to understand. All the rules and terms are defined, so everyone really knows right away what is the governance in the company, what are the deal terms, and how you will be working together. You have very clear ownership. There is no repayment obligation. Everything is clear right away. But the negotiations can be more complex because you already want to define all the rules at the early stage. And because of those complex negotiations, equity investment agreement is usually used in seed stage at least, sometimes in pre-seed. But if a company is raising like 50,000 euros, you wouldn't really go for equity investment agreement just because the legal fees will take like 3,000-5,000 out of this investment, right? So you want to make sure that it is balanced. Also, sometimes people think that investment agreement is the only thing, but it isn't. The investment agreement defines the rules of the investment, but we also have the shareholders agreement, which defines the rules of how the shareholders work together. So all of the liquidation preferences and things like that, they're actually included in the shareholders agreement. So this is also important to note. Investment agreement covers only everything that's related to the investment. And in case shares are issued, there's also a document called share subscription agreement, and it's basically just a document saying how many shares you are receiving for your investment. So that's a very simple couple of pages, just defining that you are becoming a legal shareholder. Okay, so we're moving deeper and deeper and deeper, and now we're getting into some of the key clauses that are typically included in the shareholders agreement, so defining the governance of the company, right? I've already mentioned some of them, but again, just to really stress it to you, what is important, liquidation preference, right? The payout of potential distributions in case the company is exited, in case there's a liquidity event. Anti-dilution provisions, so how are you protected in case a down round happens. The vesting schedules for the founders that they are committed, and the founder exit rights. In what scenarios the founder can exit the company and still remain a shareholder, and in what scenarios if the founder leaves, this is it. They have to sell their shares at a fair price.
We as angel investors, though,
yes,
about 10, 50, 100,000.
Yes.
Typically, there would be, your fund which would define all of this. They're not going to negotiate all of these separately to each angel investor, and we would never get these rights.
This is true, but you have to still read the document and make sure that as an angel investor, you don't have conditions that are worse than the conditions of the investor. And this might happen. So for example, they might say that the lead investor has anti-dilution provisions, and it doesn't include the angel. So
that's what I would expect.
But perhaps
it's take it or leave it.
But perhaps it should, and perhaps you also should have anti-dilution protection.
Of course, I want all of them.
Exactly. Yes. So you have to make sure that at least some of the key terms, they are good for you as well, and the investor is not taking some preferential conditions. Sometimes it happens that we have like a syndicate deal, so it's 3 VCs participating in a round. And all of them are putting in more or less the same amount of money. But one of the investors is the lead investor, and they want to get preferential conditions. So we try to negotiate on what terms they can get those preferential conditions, maybe get a board seat and we don't, and on what terms they can't, and on what terms the conditions should be the same. So I think for you as angels, it's also important to try and negotiate at least a little bit on those main terms, main provisions, to make sure that, in case there's especially a liquidity event, you get a good payout. Okay, so, or, worst case scenario, if you don't use it for yourself, you can also advise the founders on some of these terms and how the founders can also have good terms in the next round of funding. So liquidation preference is, like I said, the priority order in which investors and founders and shareholders will be paid out in case there is liquidity. And we have three very typical clauses. One of them is 1x liquidation preference. So it means that I, as an investor, will receive my money back before anyone else, before the founders, before anyone. I will be the first one to get my money back. So, if founders have an exit of 2 million and you have invested 1 million, you get the million back, and then the founders or all other shareholders, they distribute the remaining million.
Andra, may I jump in?
Yes.
The liquid prefs are working the last in, first out. That means that it is starting with the very later stage investors and getting back to us as an angels.
Yes, so angels or early stage investors typically get paid the last. So we are in the same boat as founders. Yeah. Then there is the participating liquidation preference, which means that I get my million back. And if I own 10% of the company, then I also get 10% of this remaining 1 million. So this is like extremely good for me as an investor, and it's not really fair for all the other investors. So this is like a tough clause. You don't see it a lot in investment agreements because it's very preferential. What you also have is this non-participating liquidation preference, and I think this is maybe the most common for investors. What it means that me as an investor, I have two options. One option is I get my money back, or I get a share in the total sum that will be distributed. So let's say if the exit value is 2 million and I invested 1 million, it's better for me to take 1 million back, because otherwise, if I choose the second option and I own 10% of the company, so I will get 10% from 2 million, right? And that is 200K. But if the exit value is 100 million, then of course I want to take 10% of 100 million instead of getting the million back. So usually this is what investors are choosing, because then they have the option to choose the better deal. But it still will be in all cases lower than the participating liquidation preference.
And I must say, one time I saw the 2x participating liquidation preference. That means the late stage investor taking back 2 times of his money invested and then the share in the company.
Yes.
That's crazy.
And this is outrageous. So for example, if you will be participating in a deal and you see this, you maybe shouldn't invest into that company as an angel investor, because your chances of actually making any returns are very low. So you can back out, and that's why it's important to know these clauses, because there might be very little opportunity for you to make money if the terms are really outrageous.
But in the angel round, you may not see any of this, but in the next round, the next investors get all,
It can happen, yes.
This is where, you as a small player
Yes.
get.
But then maybe you talk with the founders and you also advise them and you say, okay, look, this is not standard. Try to negotiate this with the investor, because it also affects the founders. Like angels, honestly, they are the closest to founders, right? So you can always protect your interest by educating the founder and by making sure that they have good terms, because you will also then have good terms for yourself. Right, so here, just very quickly, yes, the 1x liq pref, it basically protects the investors, right? The participating gives a lot of upside, and the non-participating is kind of the most fair, because it doesn't allow the investors to double dip, so kind of to take the proceeds twice. Okay, now we have the anti-dilution, and this is important in case the company will raise a down round. So in case the next round of funding will be at a valuation that's lower than when you have invested. And in current market environments, it does happen sometimes, unfortunately, but yeah, the things are the way they are. And usually you have 2 types of protection. One of them is called full ratchet, and the other is weighted average. So we're getting into a lot of terminology now. It can be a bit clumsy, but let's see what we are basically talking about. So with the full ratchet, basically you adjust the conversion price to the price of the new shares issued in a down round. So what this means is that you are really fully compensated for the decrease in valuation. So you as an investor, you get full protection. The thing is that if this happens, it becomes very, very dilutive for founders. And that's why full ratchet protection is seen as unfair for the founders, and therefore good investors, they don't really include it in the investment agreement, right? So if you see this, again, talk with the founders because it might be a potential future problem. The weighted average protection is much more typical, and the weighted average basically says that we will take the share price of the new shares and of the shares that you own, and based on the total number of shares, we will weight the average, so your price of shares will still be adjusted, and you will be protected from dilution, but this one is much more fair to all the shareholders, and the founders will not get as diluted in this scenario. So weighted average anti-dilution provision is much more typical in the market. Okay, then we also see the vesting schedule, and basically this is the timeline of when the founders will unlock their shares. So they don't get their shares right away, but instead they are vested over a period of time. This way to incentivize the founders to really keep on building. And usually there is a 1-year cliff. So after first year, maybe they get like 20% of their shares, and the remainder vests monthly or quarterly or annually over the remaining period of time. And common practice really is, like 4 years, 20-25% after first year. What is interesting is that sometimes there is a vesting schedule, and the new investor comes in the next round of funding, and they tell the founders, let's restart the clock. Let's restart the clock, and only from now your shares will start vesting. So that is also not super fair, right? If the company has been working for 2-3 years, and then the new investor comes in and wants to protect their interest by ensuring that the founders are locked in. Then you also should advise the company that, perhaps a certain percentage should be unlocked already just because you've been working on this for a while. What else do we have are the exit rights, the drag along or the tag along. And this is basically the definition of rules in case of an opportunity to sell the company. So in the drag along case, we define in what scenario minority shareholders will have to join the deal. And this is important for you because usually you are a minority shareholder, you have like, I don't know, maybe 2, 3, 5% of shares. So in the drag along clauses, you will see certain rules. For example, if a majority shareholder that has 50% in the company decides that they want to sell, small shareholders will also have to sell. But it is very clearly defined what these scenarios are, so you also can look into them. The tag-along is another case which says that you will have the right to join the deal. For example, if a majority shareholder wants to sell their shares, you as a small shareholder will have the chance to join the deal. So, again, certain rules are defined. This is to protect you, to make sure that, someone will not just sell half of the company's shares and you will get nothing. So this is also like a protection for the minority shareholders. What we also have are the exit rights for the founders, the good leaver or the bad leaver. And here we define certain rules under which the founder can receive their shares if they leave the company and which scenarios they cannot. So these are actually very strict for founders usually. And typically they only are a good leaver in case of retirement, disability, death even. Yes, this is also included in a good leaver clause. Or there is constructive dismissal. So it means that, everyone constructively agrees, like, this is it. We don't see you in the company anymore. We shake hands and you're a good leaver. In a good leaver, usually the founder retains all the vested shares. So all the shares stay with the founder, which can be problematic for the company, because they will have someone with large shareholding in the future that is not actively involved in the company. That's why the conditions are so harsh. In bad leaver, basically anything else. Anything else besides retirement, death, disability is called a bad leaver. And this is actually very, very tough on founders because, they might get tired. They might decide that they don't want to do this anymore. They might decide that, they don't believe in the company, et cetera, et cetera. And in majority of those cases, they will be a bad leaver and they will have to give back all the shares of the company, typically at face value, which can be very, very low. So founders really commit to doing this. There's no way back. Like if they decide to raise money and they sign the shareholders agreement, they're locked in. Good. So these are the terms you really can remember, look into. I think maybe the slides, they will be shared afterwards, right? So you can also, oh, super, very good. So you can always check. In case you have questions, ChatGPT is your very good friend. It can really provide answers to basic questions very well. But just to kind of very quickly look at the tips and tricks. So really, when you want to invest in a company, look into things beyond the valuation, right? Valuation is only one thing, but there are many different clauses that you need to be aware of and to make sure that you have good terms, that you are protected as an investor. Try to use clear documentation. Yes, we talked that only Estonians have the standard documents right now, but if you use some templates then things become much, much easier if the documentation is well prepared. So we are also trying to work together with other VC funds to improve our investment agreements. So, we will look into theirs, we compare it to ours, we think, oh, this is a good term, we should include it. And we try to work together to improve over time. Yes, the vesting schedules, it's important for you to make sure that founders really, they are committed to building. When you look in the investment agreement, you also should think about future funding rounds, not only to think about today, but also what happens if the company successfully raises, what happens if there's a down round, right? So you want to make sure that all of those rules are predefined. And of course, legal advice is costly, but dealing with legal misunderstandings usually costs much, much more. So it is less expensive to take a lawyer, look into like the standard documents, right, and get their opinion, than get dragged into this safe story, right, where you really will spend a lot of your time and money trying to minimize the potential damage. So in case you have questions, really just involve lawyers, and we have very, very good expertise now, I would say. People really understand how these investments work, and they can make sure that you are protected. So this is it. Thank you so much. I hope that you learned something new. And if you have some questions, yeah, happy. Thanks.